I'll give you some feedback, bitch.
All right, we are recording.
All right, we're live. Go ahead and start it.
All right, this week's presentation is on SPACs. What are they and why do we care? How can we use this to make ourselves some money? What is a SPAC? SPAC stands for Special Purpose Acquisition Company. Company is formed solely to raise capital in order to acquire another existing company. So they basically IPO the SPAC under a ticker, and then with that money that the company raises on its IPO, they use that money to acquire another company and take them public. They are generally formed with an expertise in a certain field. You know what sort of company they're looking to acquire. SPAC has 2 years to find a company to acquire it, or it will face liquidation. SPACs were popular before the financial crisis. However, they fell to the wayside after. They've only recently seen a rise in popularity. I think
Do you have
already.
slides going on here?
Yeah.
Okay. They weren't
stream.
loading for me.
Generally speaking, like for a SPAC, they usually change the ticker after a certain amount of time,
Yeah,
don't they?
I'm getting there.
Sorry.
Like I believe I read today that there was like 108 SPAC IPOs in the last year, and it was like 90 billion worth of IPO or something like that. So they're getting very popular. There's only like more coming right now, but it does face an issue of too many SPACs with not enough target companies. So that's something to watch out for. SPAC shares before the merger. Once a SPAC goes public, you can buy into the company with either common shares or warrants. Warrants are a right to buy shares at a later date. The warrants expire after 5 years and hold no value if a merger does not occur. So it's similar to like an option. So the SPAC is set up that the shares start at $10. This is important because if the SPAC fails to acquire a company, liquidation occurs and they are required to pay out $10 a share. Closer to 10, we can buy into a SPAC. We reduce our risk substantially. Buying in at 11 presents a maximum loss of 9% pre-merger. So getting in at that $10 range is huge because you basically face little risk and you have all the upside, especially if they acquire an awesome company.
I've seen SPACs at $9, so that means that they would have to pay me 10 if they don't go.
Yeah, but if that's only if liquidation. So if they are trading at less than 10, but they have a target, I mean, people can just be like, we don't like that company, and then the value drops under 10, and then it just moves to a market. But if they don't have anything targeted, then there's no reason it should be under $10, unless you believe that the management team of the SPAC sucks.
Okay, cool.
Because you have no risk if the liquidation occurs. What happens at merger? Once SPAC and the target company merger is finalized, the SPAC ticker falls off and the target company's ticker is now used. Shares are transferred to the new ticker at 1-to-1 conversion rate. If you had 50 shares of the SPAC, you now have 50 of the target company. Be careful of valuation issues upon SPAC mergers. So if the SPAC is worth like 400 million, I guess I put an example here. The SPAC may be trading at 1 billion market cap, but if they're purchasing 25% of the target company, true valuation is a $4 billion company. So essentially, it just gets diluted. And so if you're trying to value the company at their financials based on the valuation of the SPAC, you're going to be fucking up. So you need to take into account of how much of the company they're buying or whatever. So I've seen a bunch of people fall into that issue of saying like when DraftKings was going through the SPAC process, the value of the SPAC was only like 800 million, but they're like, DraftKings has 2 billion in revenue. This is trading at such a discount, but it's not really because of how much of DraftKings they're buying and how many shares were going to be on the market at merger. So something to watch out for. Management and visions. Similar to when we were locating standard stocks to invest in, reading into the management and vision of the SPAC is very important. By understanding the management and looking into their vision, For the SPAC, we can deduce what kind of company they will be acquiring down the road. Using this information, we can find market trends, i.e. fintech, and maybe locate a SPAC that's likely to acquire a company in this field. So basically, when they start the SPAC, you can get a pretty good idea of what kind of company they're looking for. Like Shamas, he has a bunch of them, and he's basically come out and said what each one of them is trying to locate. And they're just different. The different SPACs are doing different things, so that's also important to account for when you're trying to find one. Successful past SPACs. We have Space, Virgin Galactic, developing commercial spacecraft, now trading at $33. DraftKings online gambling platform, now trading at $52. Nikola, shout out Johnny, piece of shit company that at one point hit 70, is now trading at 20.
Fuck Nikola.
Yeah. Oh god, what a disaster that company is. Why do we care about SPACs? SPAC gives retail investors like us a chance to get into a company before insane IPO valuations occur. Retail investors have been getting absolutely screwed on recent large IPOs due to institutions gobbling up shares and inflating prices while unavailable to retail investors. Present minimal risk to your investment if done correctly, which is a nice change of pace from the YOLOs. So if we can find good management team with a good vision for where they want to take their SPAC, we can get in on early before the IPO and kind of have that head start on the company, which gives you a nice cost basis going in versus like we've seen in the last couple of months, all these big tech IPOs, we're getting absolutely fucked. In the morning, we're talking about trying to buy in at like $20 a share, and by the time it hits the markets, it's at like 100. So it's pretty insane. I mean, I feel like the IPOs are going to come back down to earth, but just what we've
Fuck,
seen
I hope
lately.
so.
But with all these like fintech and tech IPOs, SaaS ones lately, it's just been insane. And the retail investor basically is jumping in at, in my opinion, risky prices. But with the price to earnings ratios, what they are now, maybe it's not as risky, but it also just sucks buying in on a day where the stock went up 250%.
Yeah,
That's
like
kind of like
my Affirm. I think it IPO'd at 49, and my price triggered at 92.
yeah, and it's just a psychological thing. We're seeing 100% increase in trying to buy in is like hard to do. So this is kind of a way to give the retail investors we have the same chance as the institutions, and generally we're ahead of the institutions on it because they're not going to buy into the SPACs until the company's announced. So if you believe in the management, then you can get a huge head start. The risks associated with SPACs, the unknown of what company will be acquired, even though we can get an idea from management what type of company will be acquired, we still have no real knowledge of what will take place. It's just you're putting your money in the hands of an idea with SPACs instead of an actual company. So there's obviously always going to be risk in that. And if they acquire a piece of shit company, you can kind of. But when I buy into SPACs, I'm not really buying in at the huge valuations of them. So it's not as much risk, but there's obviously still downside. The time it takes for the merger to take place is a long process due to it being a merger and acquisition / IPO. Previous SPACs have fallen through during this process. I remember having DraftKings. This process takes a long ass time. They'll announce the target company, and it's like sometimes it's like I think it can take up to like a year. So, and there's things that can go wrong, and it's costly for the company. So, it's also an issue. And another thing is they don't have to file an S1. I think they file an S4 with this, but it doesn't feel as detailed, and they don't go into as depth with the company where a traditional IPO, you get that S1 and you have a long time to go over it. So there's that as well. Do you have any questions over the SPAC so far?
What So what are the major differences between an S1 and an S4?
I was trying to look that up and I wasn't really getting like a uh clear answer on it. But it just feels like when companies drop their S1s, it's pretty fucking in depth
Okay.
for a traditional IPO.
So, quick question.
Current SPACs to watch. Pershing Square Tontine Holdings. It is a very large SPAC with the value of the SPAC at almost $6 billion. Bill Ackman is the person that's leading this SPAC. Runs a hedge fund and has a personal net worth of $1.9 billion. Looking to purchase a mature unicorn, even made an attempt at Airbnb. There's a chance that it doesn't find a target company to acquire, and it's already trading at almost $30. I feel like with this one, they're just trying to get so big of a company, and with the way that IPOs have been going off lately, why would they choose to go the SPAC route instead of just cashing in on a huge IPO? Where it's like, I'm sure Airbnb made so much more money doing it the way they did. We're just going through an SPAC. So
I got a question on this. So if I'm a company, why would I choose to do a SPAC as opposed to an IPO?
That was my question as
generally.
well. I had
You don't
myself I had myself muted, but that was I don't get it.
You don't have to deal with the big bank issue, and you're in more control over it. And you're picking basically who owns a portion of your company. So like, if you're an electric vehicle company, you can have Shamath take you public or whatever, and then you know that you have his management as well. So you kind of like, it's kind of like a team effort at that point.
So, is it like, as opposed to letting the market build you up, you put like, it's kind of like an offering where you get like VCs
Yeah.
to come and fund you?
And it's guaranteed money because the VC's giving you that
Okay.
money. You're not letting the market dictate. So
Okay,
they're
that makes sense.
Yeah, you're getting that guaranteed 500 million for that for your portion of your company, whatever the number is. Like this would be a $6 billion with this one.
And I assume then, because like with IPOs, you're usually going through some big bank, and then they charge fees on top of that, and it's still up in the air on what you're actually going to
Exactly.
make at IPO time. Okay.
And you're also running the risk of the IPO market changing and you getting fucked. Like right now, they're probably going to be everybody just going the IPO route. But back when IPOs were getting shit on, the SPAC just made a lot more sense, in my opinion, because you get the guaranteed capital. TWTCU Tech Holdings. It's trading at the U at the end because the SPAC's IPO is very recent. So it stands for TWCTC unit, which is if you buy like one share of the unit, there's different ratios and it gives you like half warrants, half common shares. But eventually it'll just trade to TWTC and you purchase that and it's just a common share. But right now, if you bought into it, you'd actually be buying warrants as well as common shares because it hasn't split yet.
Do you know how that payout would be? So like if they don't find a company, would I get like, I don't know, like 575?
Yeah, I think it depends on what the ratio of warrant to share is. If it was 60-40, then you'd probably get $6 or 60%. You'd get $6 per, and then you'd lose the rest. I wouldn't buy in as while it's a unit. I just wait for it to change the ticker and buy only shares. Honestly, is what I would do. It's looking to target a tech-related company in the $1 to $10 billion range, and they're looking for a SaaS disruptor, which is just basically like using buzzwords. I mean, everybody's looking for a SaaS disruptor. So, but they have a good management team as well. So, they're currently trading at 11.50. So we're getting kind of early if you buy into this one. But obviously, right now it's probably trading at a slight discount just because it's the units. So you're buying warrants as well. I'm guessing if once it switches to just the TWTC, it'll move up to like 13 or 14 because those will just be common shares. CCIV, Churchill Capital Corp, and this is the fourth. So a lot of these ones, and the next one is same thing as well. They have like a SPAC group and they just keep on starting new SPACs, but it's all the same management and they're just targeting different types of companies or maybe a bunch in the same industry. But it's nice to get these ones because that means that they've been successful in the past. So this one is recently rumored to have targeted Lucid Motors as its acquisition, which is an EV company. David Klein runs the SPAC and has produced 2 previous successful SPACs and then a third still searching for its target. Rumors have caused this stock to soar and is now trading at 23.40. If these rumors were proven to be false, the stock would plummet. So it's just a rumor that Lucid Motors is the target company. So if that like fell through, you'd probably get fucked. Like it would drop back down to $14 or $15. So as long as but once the rumor's confirmed, I'm guessing it would fly because electric vehicle companies are absurd right now. So there's definitely risk involved with this one. Just how much you trust the rumor, and they've said before that they're one an electric vehicle company, so the Lucid Motors does make sense. But that's one I would research a little more into the rumor and how trustworthy the source is on that. IPOD, Social Capital Hito Sophia the fourth. It's got a dope ticker, just iPod out there. Everybody knows iPod. Sharmath, I don't even know how to say his last name, is leading the SPAC, and if you haven't looked into him at all, he's really into like activist companies. So he's looking for green companies and things that have a positive impact on the world. Obviously, he still wants them to be profitable as well.
He's a fucking pimp, dude.
Yeah, he's awesome. So his automatically basically trade at a premium because they're associated with him. This one's currently trading at 17. His previous SPACs have jumped into the 25 range at the announcement of mergers. So this one's already trading at $7 over the 10 just because they're associated with him. But upon announcement, they get a boost. He's proven to be a trustworthy management source and a good place to park your money is with his SPACs. I don't really see him making a bad decision on the next company. Now, whether or not 10 years from now they're great, but if you're looking for a short-term purchase, this feels pretty safe to me. They just pop on his announcement. He's a shit ton of followers on Twitter, big in like the FinTwit world. So when he says something, he can actually like move some markets. Like if he's tweeted about like little electric vehicle companies and then they'll like pop off the next day. So having him is just basically just advertising for the stock as well as just having him as your chairman.
He also, if you were to, in the year of 2020, if you were to buy everything that he SPAC'd, you would be up like 370%, something crazy like that.
Yeah. And then, so this one, you're basically just hoping that merger rumor surfaces soon and you'll get that. How big of a jump, I'm not sure, but I believe it's definitely going to go into the 20s. So we're looking at what, 20% gain, 17% gain ish, even if it only hit $20. So that feels pretty safe to me. And that's my SPAC presentation.
Hey, share your screen again.
Oh, did I?
Yeah, share your screen again.
1 second.
We'll give you an opportunity to give me a live demonstration here. So look up VIH. I'm curious because I have 150 shares of this, and if you tell me that it's bullshit, then I'll walk.
Is VIH the ticker of the? Oh yeah, right here.
Of the SPAC. So Intercontinental Exchange owns this thing called BACT, which
I
is
don't
basically what-
see